going to be learning about how to execute with time trading gold, and also we're going to be learning patterns that are going to help you predict the price before it even happens. So that now you can know when to execute, when to exit, and when to stay in a trade and hold for long hours and be profitable and consistent, be able to make risk to reward of 1 is to 5, 1 is to 10, 1 is to 15, 1 is to 20, and so on. So far, my risk to reward, the highest I have done was 1 is to 100. Imagine 1 is to 100. That means taking at least a small account, which I don't know the risk to reward I've done. It was the highest was taking was $3 all the way to $380. It was 1 to 100, yeah, risk to reward. So that was a very powerful trade. That was not my highest trade, but it was one of the powerful trades I've taken so far. So nonetheless, today we're going to be learning about risk to rewards and chart patterns that can help you to execute trades. Hold on. Yes. So as I said, so now the lesson begins here. So as I'm just going to have we're live, we're on chat right now. So so far, this strategy is going to be working on gold so far, and as the gold is the pair we're trading. So let me just try and adjust the screen so you can see. Perfect. Okay. So what are we learning on gold? Is that gold is a very volatile pair. We can expect at least 100 pips a day on gold, 100 pips and more. The minimum we have seen on gold is 100 pips a day, but gold can rapidly take us to higher amounts, higher pips. It can take us to at least 150 pips, or yeah, gold can move. So the first strategy I'm going to be teaching you, the first method I'm going to be teaching you guys on how to trade this thing is wedges. So wedges is something you've seen, you complicated it maybe by something like this, right? So now, a wedge is a flag, you understand? So now if a wedge is going to the downside, why it's going to the downside, it's always confirmation, it's always the guarantee, it's going to be buy. It's going to be buy. You understand? It's going to be buy. Always guarantee. A wedge, falling wedge is always going to be buy. I'm not saying here, I'm not taking chances with you saying, or maybe it's well. I know, I've seen it, it's there, it's proven. You understand? A falling wedge always will buy. End of the falling wedge, just expect it to be buy and breaking out. It's always there, you understand? The only way you can mess it up is you spotting the wrong wedge, or you complicating it, saying it's a wedge, why might not be a wedge, understand? So there's a falling wedge and then there's a rising wedge. So this one is falling. So a rising wedge, so you can see falling wedge comes from a bullish market, right? A rising wedge comes from a bearish market going upwards. And here is going to be selling. This one is going to be selling, this one is going to be buying. That is the simple concepts of how you can start making profits. Simple ways you can start making profits. Falling wedge, rising wedge. Simple. Those are the best things you can learn in the market. Falling wedge and rising wedge. These are the things you can start learning in the market, understand? So now since we have a falling wedge and rising wedge, there's also falling trend lines and rising trend lines. Trend lines is very different from wedges. Same concept is, but very different. Yeah. So trend lines, you know, they're always rising. So the first way we confirm it's a trend line, we have to always have 3 touches. So first touch, second touch, third touch. The third touch, most likely in the third touch, we break out. If it's not the third touch, we break out in the fourth one. But once we break out, we always have to now break the third touch. See, on the third touch, as the market is broke the trend line, but it has to, when we confirm that it's a trend line, we always have to break the third touch lower, and because the third touch is now a demand. It's a demand. So again, it's a demand because there's buyers here. There are buyers here. Buyers are always here. So we have to break it in order for us to start selling to the bottom side. And the concept of this, for you to have great risk to rewards, is we have to hit the 90% rule. So the 90% rule, it It's where it started. It's where the trend line started. Where the trend line started, it's the 90% rule. The 90% rule, we touch it, we're going to manipulate. This is what I'm saying. We are going to manipulate the 90% rule. It always happens where we manipulate it and then we go back to the direction, the top side. Because now people think it's going to continue selling the greedy ones. They think, we're still hitting lower lows, you understand? It always happens. If you can check, go to Nasdaq or US 30, look in the beginning in fact, the end of the tariffs, while the market was crashing, and tell me what you see. This thing happened here, the 90% rule. Many traders like me who trade like this, they caught this movement. I was one of them who caught the movement. At the end, what was happening? Everybody thought the market was still going to crash. No, we executed. Nasdaq hit higher highs, US 30 hit higher highs, the Dow Jones hit higher highs, S&P 500, same thing. All you have to do is just catch the 90% rule. Know the 90% rule. It's going to manipulate the 90% rule. After the manipulation, that's where you enter. After the manipulation, so manipulate as it comes back into your zone. Enter. Use risk management. Use risk management. And then you call it. Yes, that's simple as that. So this wedges, 90% rule. Obvious, what happens in the bull side always happens in the bears as well. You understand? Always happens in the bears. Where this side, since this one was falling, you see this one was rising, and then it's gonna say as soon as it's falling, it's going to be what? Noise. Why? Right? Falling. This one is falling. Hold on. This one is falling, so this one is supposed to buy, right? Oh yeah, I confused myself. So this one is selling, yes. As you can see, it broke out, and so this one is gonna break out and buy to the top side instead. I confused myself there a bit. But as long as you understand these concepts of how these markets move, it's going to be a piece of cake for you. It's going to be an easy piece of cake for you in trading. I'm telling you, my friend, trading is going to be a piece of cake. Trading is going to be a piece of cake if you understand these concepts. Because these concepts help you understand the market, know where the market is going, and predict the market where it's going. That's why I'm using this simple concept. The next concept that is best and one of the best, me as a scaling trader, right? A scaling trader is a simple trader, obviously adds trades as the market is going higher and higher and higher. And I tend to add trades to make higher risk to rewards using risk management instead. So the next pattern that is aligned with my trading style and it can help you as well is the Elliott wave, which is we have 5 waves. We have 5 waves. So we have 1, 2, 3, 4, and then we have 5 here. You understand? We have wave 5 there. You understand? So what happens with the Elliott wave is that now the Elliott wave is a simple theory, a simple concept of the market trend. So it's a simple market trend. The market is always trending. Of course, the trend is your friend. So now how you can treat this thing is correction is number 1. So once we mark the correction, so now we see correction, wave 1. Wave 2 is where we start to execute. But wave 2, we have to work the minimum percentage is 80%. But the normal percentage is 20%, 40%, 50%. You understand? Of the correction. The lowest you can go is 80%. If it reaches 100%, it is invalid. Invalid. So if it reaches together with this level, it is invalid. It always has to cover being 80% or 50% above the level. You understand? And then within the level, and then you start executing trades. So you buy here. You buy here. Wave 3. So after you buy here, look, wave 2 is the longest. It's the longest. You understand? And in wave 3, it's your choice. You want to exit the trade to take profit, or you want to add more trades at wave 1. Wave 4, you want to buy again at wave 4, which is, I do that. I buy again at wave 4 because I scale in my trades. Wave 4, you buy, take profit. Is wave 5. TP is wave 5. You are done. You're done. You understand where the market is going. It's a simple concept. But now this simple concept is now if wave 3, in fact, let me just say, if the correction of wave 3 goes below wave 1, so if it goes, so this is wave 1, this is wave 3. If wave 3 pushes lower and lower and lower and comes back in wave 1, it is invalid. So, because now wave 4 has to be on top or above wave 1. So now remember the correction of wave 3 is going to form wave 4 where we start to execute again. You understand? So we don't want this wave 3 to be lower again. We want it to be above or on top of it. So we can execute bars again high. You understand? Simple concept. And then TP is wave 5. We are done. And then now the correction. So now someone I say now I'm gonna hold it until. Now, my friend, the market knows everything and it respects everything. We have A, B, C. Same thing. Now, once the market, so this is the correction. ABC is a correction, you understand, of this Elliott wave. ABC is a correction of Elliott wave. So what am I saying? ABC is a correction of Elliott wave now. Wave 4 we're going to mark it. So once we have A is like 1. So we have A, B. B is like 2. We execute here, sell. If you still want to enter, you execute the sell. This sell is the impulsive move. This is where we enter. We only have one entry with this one, which is B. Take profit is C. The first take profit is when C hits 4. Once C comes to 4, that is the first time you exit. Because why? C always manipulates, goes lower, tricks you that it's going to continue selling. The case is, it always comes back to buy. If you check currently the state of gold, go to the 1 hour time frame, check, look for the Elliott wave. You're going to find exactly what I'm talking about. Gold was selling, right? After the sell, I want you to look at the Elliott wave that was formed there. It's this thing. That's what's happening. That's why currently gold is buying, because it completed the Elliott wave. Understand? And now it's forming an Elliott wave. So after C, we form a new Elliott wave. The market keeps on doing this cycle over and over and over again. You understand? Over and over and over again. Simple stuff, simple stuff. Yeah, so I told you the word is, I told you, so now it's time for time. It is time for me to teach you about time. So time is one of the most important things in trading. Time is one of the most important things in trading. Time is one of the most important things in trading. Time. So time, and these concepts I'm teaching you about gold. Yes, I can also teach you concepts on USDT and Nasdaq. Just let me know if you want to learn about USDT and Nasdaq. The reason I'm teaching about gold is because majority of traders trade gold. So let me know if you want to learn about USDT and Nasdaq time when we can execute Nasdaq and USDT and actually make a movement, avoid manipulations. Yeah, but now we're focused on gold. So gold time. So now, as you know, the market is daylight savings, so everything moves forward by 1 hour. So if we used to trade at 3:30, 3:30 is now 4 o'clock. Understand? 4:30, I mean. Understand? And then what else? 2:30 is now 3:30. If you can check the fundamentals are now coming out at 2:30. They're going to be released at what? At 3:30. So make sure you focus on that as well. So right now I'm going to be teaching you about those times, the golden time, the golden hours. So the golden hours for gold is now a symbol. Gold, we trade it, the best time to trade gold is in the morning, the AMs. The AMs, I don't know if you can see guys, but the AMs is one of the best times to trade gold. So 3 a.m. was the time, but now it is 4 a.m. to 5 a.m. You understand? That is the best time to trade gold. And then we move into what? So to moving from 3 a.m. to 5 a.m. No, to 4 a.m. to 4 a.m. to 5 a.m. to 7 a.m. 7 is one of the most powerful ones. 7, and then we let go, we release. If you can see a direction around 10, because from 10, once it's in 10, from 10 PMs, 10 all the way to 2:30, no, to 3, 2. So this is, okay, let me just say, these are the best times: 4 a.m., 5 a.m., 7 p.m. Simple that done. You understand? You hold until, because why am I saying this stuff? It's because gold loves, so around um, around 10, so let me just say it's 4, 7, 5, right? AMs. Yeah, now you can see, I know you can see. Golden times. Right? Good, okay. So from 10 p.m. all the way to 3 o'clock, right? To 3:30, right? Gold is going to consolidate. Here, you hear what I'm saying to you? I'm saying gold is going to consolidate at this time. So right now at 10, all the way to 3, gold is consolidating. Gold is consolidating. It's wiping your cash. It's consolidating. It's consolidating. Yeah, I've said it now. Gold consolidates at these times. Why does it consolidate? Because now, since the market gold is consolidating, the euro market is only open now. The euro market, most majority of traders don't trade the euro market. That's why when it goes towards 3 o'clock to 3:30, it starts moving again. Why does it start moving again? Because we're approaching NY session. That was N. We're approaching NY session. NY session now is at 16:30. 16:30 is the session, New York session, NY session. It's where the most volatility is there, you understand? So that means now there's more buyers and sellers in the market. So market is active, you understand? There are kids in the playground. Everybody is there, is trading, market is active at 16:30. It was 15:30, now it's 16:30 because of daylight savings. Everything moved forward by 1 hour. So here you can see 16:30. And then the next thing we're gonna do here is that at this time, we step back, because here is a lot of false direction with gold. Have you ever seen it? 1600 to 3:30, you understand? Gold starts selling rapidly. It starts selling. And then you think, this thing is selling. And then it turns back at 5 o'clock. You guys are playing with me, my friends. 5 o'clock is start selling. That's when you want to buy now or sell, whatever the direction is, based on your analysis. That's when you want to execute the real direction at this time. You enter. Or 1800, or 1800, which is 6 o'clock. We enter here, we are done. You're done for the day. We go. We are done. Simple. Understand? So here, we enter. The best rate is here in the morning, AM, 7 AM, 4 AM, 5 AM. And then 10 to 0 past that, just leave it. Leave it alone. You understand? It's going to consolidate, it's going to play with your time, play with your money, everything. As currently you are speaking, it's consolidating right now. And today is what? It's Monday. So, and then, yeah, so after that, 1600, you can execute by players helping here. You understand? Depending on the direction as well, as I said, depending on the direction, you can start here or just leave it and enter at 5 o'clock. The best time to be is 5 o'clock, because you know that direction is the quality direction, high quality direction. You can't take the eating. It's the real direction, it's going to move properly. Because this time it's called corrections now. It's corrections 1400. Here's consolidation, here's corrections. and then 5, continue that direction. You understand? But of course, you want to always be vigilant of the market and stuff like that. So I just told you times and stuff. Understand? So please like, comment, subscribe. You understand? Yeah, please subscribe because I don't subscribe, my friends. You understand? So this is the times for gold. And then let me teach you something about Nasdaq. I'm gonna just teach you one thing about Nasdaq. You understand? Nasdaq. Oh, and also USDT. So this thing is here. I'm gonna teach you this strategy. It's a short, simple strategy. You understand? Short, simple strategy. So let's say the market opens in the morning from London session, right? London session, right? From London session, we start buying. Let's say the market is buying, right? And the market is buying London session, right? Let's say at this time it is, let's say it is, what time? Let's say it's around 9. No, let's say it's around 12 o'clock. Right, that's 12 o'clock. London session was at 10 o'clock, right? 10 o'clock was buying, and then 12 o'clock it starts to consolidate to 1 o'clock, right? But it buys, but it consolidates a bit, there's that. Hey, should I teach you this thing, guys? Hey, yeah. Okay, I'm gonna teach you. 1700. Listen, 1645. 1700 or 1645. You understand? You're gonna have a big spike. Hey, I'm not saying, I'm not saying. If the main purpose of what I'm showing you this thing is because once we're here and we break this area, 5 o'clock or 1645, the market is going to start selling for at least 30 minutes and then continue that direction again. But it's going to be selling. These times. Expect the sales. And it's going to be spiking fast. Or it's a correlation of the sell. But then these times. And then we continue that direction. Shaya? You just hear power. So this is the strategy, guys. You know how it is. It applies both in Nasdaq and USDT. You just have to learn the strategy, of course. There's more to it. I'm just showing you glimpses and pieces of something you're missing. Maybe this is why you're blowing your account. You executed the wrong time. You understand? So, nonetheless, guys, keep DJ. You know the vibes. Let's go. Power.